Hey everyone. Fubo TV reported first quarter earnings results that really got the stock market excited about Fubo stock. It's up 32.6% as of this recording on the day of the announcement. So, in this video, I'm going to review Fubo's earnings results. I'm going to answer why the stock price is soaring. I'm also going to answer if you should be buying Fubo stock right now. So I'm going to do all that in this brief video. So let's begin. Starting with total net revenue for Fubo TV, which increased to 324.4 million. This was up 34% year over year. This rate of growth is significantly slower than what Fubo TV is used to, but that's okay, and I'll explain why. The net loss improved from 83.4 million. This was up from a net loss of 128.4 million in the same quarter last year. So Fubo is losing less money on the bottom line. Subscribers in North America, which is, I will say 95% of its business, increased to 1.285 million. This was up 22% from last year. That's impressive because the company's been raising prices. Fubo TV has been on a price increasing campaign. And for that reason, the average revenue per user increased by 8% to $76.79. This was despite pressure from advertising. The ad revenue did not increase by much, and the fact that Fubo TV increased the average revenue per user, that nearly all of that came from an increase in average pricing. Subscriber related expenses improved to 93% from 101% year over year. This line item is the main reason why I had been not recommending Fubo stock as a buy. So coming into this quarter's earnings results, I had Fubo TV stock rated as a sell or a hold, not a buy. And it's because of this item here, subscriber related expenses. The company spends so much money on the content that it then sells to consumers. And it just doesn't sell that bundle of content at a high enough price, which causes the company to lose so much money on the bottom line, which is why I tell investors to stay away from the stock because there is no proof that Fubo TV can run the business if it charges prices for the content enough to be sustainable, right? If it charges customers a price where the company can be profitable, will so many subscribers leave that the business is just not viable? That's the big question. That's what Fubo TV has to prove to me to interest me as an investor. And let me show you this slide here. So this is from Fubo TV, and they update this all the time. And this is the most recent update, the first quarter 2023. This is the global expenses as a percentage of revenue. So this is all its expenses, right? And first of all, it's troubling when this is over 100% because that means the company is spending more than it's bringing in. It's just losing money, right? But the good thing is that it's improving. It was negative, it was 156%. Now it's 125%. Very nice progress there. Also, in the biggest line item, this subscriber related expenses, that improved from 101% to 93%. Very good. So the price increases are starting to work, but there's more room to go. You're still spending way more money than you're bringing in. You gotta make progress on that. And management did say that this is going to continue improving as they run through their price increases. So I don't think they're done raising prices. I think they need to do more, and and it looks like you're going to start to see the negative impacts from that. I'll touch on that towards the end of the video. Let me move on to the cash flow from operations. That improved to a loss of 78 million. This was up from a loss of 119 million in the same quarter last year. So they burned through 78 million dollars in the quarter. That's how much money they went through just doing what they're doing, right? Offering this content to consumers at these prices. They lost $78 million in cash. Right? This is what I mean when I say the business is just not sustainable as it is. They've got 365 million in cash left. So if they continue at this rate, they're going to run out of money in about 4 quarters. They're going to need to raise more capital. They're going to need to borrow more or sell more shares of the stock, either of which is going to cause the stock price to decline. Moving on to guidance. They're guiding for second quarter revenue of 295 million in the North America segment, so a moderate sequential decrease, and subscribers of 1.13 million in the North America segment. That would be a huge decrease from the previous quarter. They had 1.285 million subscribers as of the end of this quarter. They're expecting that to fall by about 150,000 subscribers, 1.285 to 1.13. So they're expecting, roughly 8 to 10% decrease in subscriber count as a reaction to their price increases. So management must be seeing something in their internal figures showing that when they increase the prices, how many customers are canceling and how much difficulty they're having attracting new customers. So this is what I wanted to see. The company increasing prices and seeing the response, how many subscribers they can keep. I fully expected them to lose subscribers. That's okay. And I expect revenue growth to slow down. That's okay too. What I want to see is if the business can operate at a sustainable level where the total costs are less than the total revenue. Can they do that? Because this isn't one of those companies that is, how can I say it? So let's compare it to Netflix, right? Even though Netflix is not Fubo TV's direct competitor, Netflix is streaming content. Fubo TV is more like a substitute to cable TV. And that's the point I'm trying to make. Netflix, when it spends money on content, it spends that money for at least the bulk of its content. It spends it one time, right? It pays money to make a show. It pays money to make a movie. That movie is then on the Netflix platform forever, and they can serve customers forever. That's not Fubo TV. Fubo TV's content spending is always going, always recurring, and potentially increasing because providers like ESPN or like the regional sports networks are going to constantly try to get Fubo TV to pay them more for their content. And Fubo TV is in this not a very powerful negotiating position because without that content, they can't survive. They need that content in order to run the business. So if ESPN says, "Hey, we're going to charge you $4 more per month for this to have ESPN on your network," Fubo TV just has to, maybe they can negotiate a little bit, but they've only got 1 million subscribers, right? ESPN worldwide has over 80 million. They're not going to suffer all that much if Fubo TV says, "You know what, we're not going to carry your network on the platform." Fubo TV will suffer more. So the business is not, the point I'm trying to make is the business is not a scalable one that scales very efficiently. And you've been seeing that, I've been seeing that as I've been following the company for several years now. It's not like they spend money on the content one time and then that cost is eliminated, and then when revenue comes in, it can just create a bigger and bigger gap between revenue and expense. That's not the case for Fubo TV. Every quarter, every month, it needs to keep paying for that sports content in order to keep subscribers watching, right? So every quarter, it needs to pay for more of that content. The next season comes of the NFL, it's got to pay for that. The next NBA season, it's got to pay, it's got to pay, it's got to pay all the time. And so Fubo has to demonstrate that it can charge customers more than what it pays the people that own the content. There needs to be a gap there because it doesn't scale. It's not like it pays it one time and then the costs are flat or gone and then revenue comes in and now that's all profit. That's not the case for Fubo TV. It's not like Netflix. Netflix is more like that, and that's why I like Netflix and I recommend Netflix stock as a buy because it spends money on content one time, and then revenue comes in. Viewers keep watching that same content that it paid for in 2014 or 2016, and it just keeps bringing in viewership even though it paid for that content and it's not paying for it anymore. So to answer the question, is FuboTV stock a buy? The answer is no. FuboTV stock is not a buy. The company made good progress this quarter. I want to see more of this, and I want to see this continue. I want to see them continue keep costs under control, and we can revisit the stock in 3 months time. So no, the stock is not a buy right now. All right, that's all I've got for this video. Thank you for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.